On March the 26th, the Chancellor Rachel Reeves will deliver what's supposed to be a routine spring statement. But here's the thing, it could turn into one of the most consequential economic announcements of the year. So when Rachel Reeves announced plans to hold just one major fiscal event per year, it made perfect sense, right? And that means that spring statements will be more of a low-key event. And at the time, the Treasury claimed that this will give families and businesses stability and certainty. And that's something that we could all use right now, looking at the fact that we just came from having 4 p.m. in about 5 years. But the truth is, the UK economy is in a very, very delicate position. And the Chancellor has to make very tough choices, just like her predecessors, right? And depending on what she does, your taxes, your savings, and even your investments could be affected. So what exactly should you expect? In today's video, I'm going to be breaking down exactly what might happen based on several reports and news that we've been reading, why it matters to your money, and the specific steps you should take before any announcements are made. Okay, if that's something you want to watch, let's get right into it. In the past few months, a perfect economic storm has been brewing, right? The UK's growth has been very, very sluggish. The global borrowing costs are rising. Interest rates remain stubbornly high. And a lot of economics have warned that the Chancellor's 9.9 billion fiscal headroom that she thought she had may have significantly narrowed by this toxic cocktail that have been put together. And this has put a lot of pressure on Rachel Reeves to perform and to bring out new measures. And let me put it in perspective. Imagine thinking that you have £1,000 in your emergency funds, right? And all of a sudden you check your account and you find it empty. That's something similar to what Rachel Reeves finds herself in. The main problem here is that Rachel Reeves has actually set herself some ironclad fiscal rules. The main one that requires all day-to-day government spending to be fully funded by tax revenues come 2029-2030. If she cannot meet this target, she will have to make some extremely difficult choices. That's just what it means. And what options does the Chancellor have? Option 1 would be to raise taxes even more, even when they've promised that they wouldn't do it. Option 2 would be to cut spending, potentially targeting welfare, which would be politically explosive. And the third option would be to adjust our fiscal rules, which would be seen as having a political U-turn and might actually damage our reputation, our credibility in the market. And the fourth option would be to do nothing and hope that the situation improves, which would be a massive gamble with the UK economy, because that could trigger months of speculation and market instability. And this is something that she desperately wants to avoid. So let's take a step back, right, and look at the broader economic picture. The Bank of England recently downgraded its 2025 growth forecast for the UK from 1.5% to just about 0.75%. That's a dramatic cut that signals serious concerns about our economic trajectory, right? Inflation is also high. It's not coming down as fast as they want, and they might not be able to hit the 2% target that they set for themselves for 2027. There are also global factors like Trump and the instability that have been created as a result of Trump returning to the White House. Let's not forget long-term consequences and effects of Brexit, the COVID-19, the Russia-Ukraine war, and global inflation as a whole. For the average person, this means continued pressure on household budgets, which would mean that cost of living will still remain high. Don't expect it to go down anytime soon. And the worst part is the wage in the UK is not keeping pace with the cost of living. This is the environment in which Rachel Reeves must make these difficult decisions. So if the Chancellor decides tax rise are necessary, what might we see? The most likely candidate is an extension of the freeze of income tax threshold. That's what a lot of news reports are saying. These thresholds have been frozen since 2021 to 2029. But by extending this freeze for maybe another 2 years, it's speculated that the government will raise around £20 billion in total, which is according to the IFS calculation. This works through something called fiscal drag, which means that as your income rises with inflation, more of it is pulled into higher tax bands. It essentially is also called stealth tax that allows the government to increase tax revenue without technically raising tax rates. But here is where it gets politically tricky for Rachel Reeves. Labour explicitly promised not to raise taxes for the working people. And extending the threshold freeze would affect millions of working people, even if the headline rates of income tax and national insurance remains unchanged. And remember, just a few months ago, Rachel Reeves committed to ending this freeze in 2029. So reversing that position would quickly be a significant U-turn. Another area that might see changes is the ISA, Individual Savings Account. Now, there are reports that say that the government might consider reducing the cash ISA, allowing and encouraging people to put their money instead in the stocks and shares ISA. The theory is that this will boost the economy by directing more money towards businesses and potentially improving safer returns in the long run. Let's look at the numbers. The average cash ISA currently pays around 3 to 4% interest, while the long-term average return on a stocks and shares ISA is closer to 7 to 8%. But this comes with significantly higher risk and volatility. Forcing people to invest rather than save in cash will be controversial, especially at times when many households need to build up their cash buffer for emergency. Inheritance tax is another area where we might see changes. Currently, under the potential exemption transfer rules, right, any money or assets you give away becomes free from inheritance tax if you survive for 7 years after making the gift. There are reports that suggest that the government could extend this time frame to 10 years. This will make it harder for people to plan their estate if they keep moving things around like this. However, such a change is unlikely to guarantee much additional tax revenue either ways come 2029. The government is under mounting pressure, also from rural communities and pension providers, to reconsider the inheritance tax reform that I proposed in October. And making further changes to inheritance tax now would be adding fuel to an already large fire, and contentious fire, if I may add. Let's remember that the UK economy desperately needs a boost. After years of sluggish performance, growth is very crucial to today's government. But economic growth requires confidence from businesses, consumers, and investors. And each of these groups is currently holding back due to uncertainty about future policies. Businesses are already preparing for April's national insurance reform after dealing with corporation tax increase since spring of 2023. Some businesses have expressed concerns that this may impact job growth and pricing strategies, potentially making our inflation problem a lot worse. For investors, uncertainty about tax policies make long-term planning very difficult, and this could lead to delayed investment decisions and missed opportunities for growth. So with all this rambling, what's actually going to happen on March the 26th? The truth is, it depends largely on the economic and fiscal forecast from the Office of Budget Responsibility. If the numbers show that Rachel Reeves is on track to meet the fiscal target, they may indeed get the non-event that was originally planned. The Chancellor will actually be hoping for a favorable projections and take some awkward decisions off the table. But if the forecast shows that she's off track, we could see significant policy announcements, either tax rise, spending cut, or adjustment to fiscal rules. The most likely scenario is probably somewhere in between. We might see small adjustments that don't quite constitute a full emergency budget, but do signal a change in direction. We might see modest extensions to existing policies rather than brand new initiatives. We might see tweaks to timetable of deficit reduction rather than wholesale abandonment of the fiscal rules. Now let's talk about what this all means for you and your money. If you're a working person, if you're on a 9 to 5, the possible extension of the income tax threshold freeze means that you need to be even more mindful of your tax position. As income rises, you may find yourself paying more tax even without a change in the tax rate. It's worth checking your tax code and understanding which tax band you're in at the moment and how close you might be the next one. For savers, the potential change to ISAs, cash ISA, means that you should consider whether your current saving strategy is actually appropriate. And if you have substantial cash savings at the moment but no investment, it might be worth considering whether some of that money could work harder for you in the stocks and shares ISA instead of just sitting in a savings account. And for investors, the ongoing uncertainty means diversification remains crucial. Don't put all your eggs in one basket. Consider how different assets might perform in the economics scenario. For those thinking about inheritance tax planning, the possible extension of the 7-year to 10 years means that you might want to accelerate any planned lifetime gift. If you're considering giving away as part of your estate planning, doing so sooner rather than later could be beneficial, or even just retiring earlier if you have to. Talk to a financial planner and they might just give you that good news. To sum it up, the spring statements on March 6 could be far more significant than initially expected. Economic challenges may force the Chancellor to make difficult choices between raising taxes, spending cuts, or adjusting the fiscal rules. The most likely tax change would be extension of the income tax threshold freeze, but we could also see adjustments to ISA and inheritance tax. As promised, here are 3 actionable strategies you could consider before the spring statement. 1. If you're near the tax threshold, consider increasing your pension contribution to reduce your taxable income. Number 2, make sure that you're using your full ISA allowance for this tax year before April 5th in case the rules change. And number 3, if you have been considering lifetime gifts as part of inheritance tax planning, you might want to accelerate those plans. But whatever happens on March 26th, I'll be back with a full breakdown of the announcement and what it means for your money. If you found this video helpful, please hit the like button and subscribe to the channel for more financial insight and practical advice like this. Until next time, take care.